Welcome back, everyone. I hope you enjoyed your networking break. We're going to look now, extend the theme that we were just talking about, actually, with Mr. Hartmann. We're going to look at the competitiveness of the EU financial services sector post-COVID-19 and indeed in general. Competitiveness, we mean both internal and external. So we'll look at the management of the European market, but also how it fares vis-à-vis different jurisdictions as well. You might notice perhaps that I'm British, and you might also note that the United Kingdom isn't in the European Union. So I concede these things are true, and where necessary, apologise for them. But I can promise you I've spent many years going in and out of European banks when I worked at Euromoney, and now a lot of time in European central banks with OMFIF. We've got a great panel here to discuss these themes, and we're very keen as well that you chip in with your questions. There's an enormous amount to talk about here, and I'm sure we'll revisit banking union, capital markets union. But the competitiveness agenda is in fact broader than that. We'll touch on digital, crypto, and ESG as well, I'm sure. So the panel we've got today, we're lucky to have with us Barbara Brandtner, Director for Markets and Cases 3 Financial Services at the Directorate General for Competition at the European Commission. We have Alexander Lehmann, who's non-resident fellow at Bruegel and also works with the Frankfurt School of Finance. And we have Dr. Matthias Liermann, who's Global Head of Product Management, DWS Investment GmbH. So welcome to you, and looking forward to chatting with you today about this topic. I heard last night and today some pretty downbeat assessments on capital markets union and banking union, and we'll come back to those. There's plenty else to talk about as well. On the positive side, we heard from Mr. Hartmann efforts to galvanize private sector capital, which has long been talked about and perhaps will now move. We all know the comparison between US and European markets in terms of the relative importance of bank finance, and I'm sure we'll keep coming back to that. But I want to start, Barbara, with you to set out the broad principles that the Commission uses to think about this theme. Why don't we start with that, and then we'll dig into lots and lots of specific action points and areas of activity. Now, remind us what principles, Barbara, the Commission uses to balance consolidation and critical mass within the single market on the one hand, and Mr. Hartmann talked about some of those, versus its work to protect consumers from the formation of cartels, monopolies and state-sponsored competition on the other. How do you balance those things, and how does this apply in particular to financial services? Over to you, Barbara.
Okay, thank you. Thank you very much. Thank you very much for the invitation. And you will not be astonished that coming from DG Competition, I may have a slightly nuanced interpretation of competitiveness as compared to maybe some others. I was very grateful to Mr. Hartmann that he indeed mentioned competition policy as one of the instruments to bring about market integration, and I would like to focus my first intervention on that, because for us, let's face it, it is competition that drives and enables competitiveness, and that is true for financial markets as it is true for markets at large. And so what we are trying to do is to make sure that, when you keep markets open, when you keep them contestable, this is what allows companies to innovate, this is what allows companies to grow and to scale. Now, we're of course all aware, and I think we shouldn't, hide from the truth there, that especially in the financial markets, you still, how should I say this euphemistically, the single market is, say, incomplete. Yeah? But for us, despite this fact, and despite the fact that we therefore also in our competition enforcement have to recognize that some of these markets sadly are still national, we still believe that even in a regulated market, strong competition enforcement paired with the right regulatory action is what you need to do. And there is one example maybe that I would like to use this morning in order to illustrate this point, and I could give many more. I could talk mergers, I could talk state aid and what we've done, via the temporary framework, the temporary crisis framework now, in order to stabilize, liquidity for companies. But what I would like to focus on as an example is our antitrust enforcement in the area of digital. Namely, as you're probably aware, we have on the 2nd of May, the Commission adopted a statement of objections against Apple concerning concretely Apple Pay and the reservation of the NFC antenna to Apple Pay only on iOS and iPadOS. Now, why am I using this example? Because at the same time as we were working on our antitrust case, we've also, made significant progress on the Digital Markets Act. And I think Agnès earlier on was much too modest when she talked about the great achievements of the French presidency, because honor where honor is due. Both the Digital Markets Act and the Digital Services Act have been adopted in record speed, which is remarkable. Now, when you look at these two things, you see that competition enforcement and regulation are complementary instruments. The DMA, yes, the ink on it is not entirely dry yet, so we can't discuss the details, but the principles. The DMA will embody a lot of learnings that come from our enforcement practice. And so the conducts that the DMA will define, and they are relevant to payments, yes, they're also relevant to financial services to the extent that, certain companies would found to be gatekeepers designated under the DMA. Two aspects I think I would like to mention before I stop, because both I think will be interesting for our debate. One, interoperability as one of the big obligations that will be enshrined in the DMA, and two, data, access to data, ownership of data, how to make sure that access to data operates on, fair, reasonable, non-discriminatory conditions. And maybe, so for us, the combination of vigorous antitrust enforcement on the one hand, and making sure in, regulatory actions maybe taken by other services of the Commission to embed a competition logic and competition principles, I think, from our perspective, would be what drives our contribution to competitiveness.
Your specific remit, you're focused very much on antitrust, as you've just been saying. Do you think that is more important than attempting to reduce barriers to cross-border integration within European financial services?
Well, I have to say that there are limits to our competences. Let's face it, that a number of obstacles that were mentioned by previous speakers for further market integration, such as insolvency laws, such as taxation systems, are outside, or largely outside, the regulatory remit of the European Union. Taxation is governed by unanimity, which means that, as we all know, it takes more than an eternity to make even the slightest progress in this. Same thing for insolvency law, and I have to say that I think we'll be very interested in seeing and also assisting our colleagues in DG FISMA when they come forward with their ideas as part of, by the way, the next review of the crisis management and deposit insurance framework, to align some of the national insolvency systems. So no, I don't. For us, enforcement and regulation must be complementary. There are regulatory barriers which no competition enforcement can overcome, unfortunately. So we're really trying to work on both sides.
Finally on this topic, where would you draw the line between leaning against the formation of monopolies and the facilitation of creating companies with critical mass that can compete on the world stage?
This is it's always a bit challenging from the perspective of DG Competition to answer this question, because luckily, we haven't heard that much criticism yet in the financial services sector, but of course we all vividly remember the Siemens Alstom fallout. Yeah? So I think I just have to reiterate, and now I'll maybe be talking merger control for a bit. The objective is not by merger control to prevent the emergence of large actors. There are significant numbers of large actors happily active on the European market. So this is not the problem. The problem is to prevent situations in which, for example, via a merger, a certain part of the market stops being contestable. And I'll again, even though it's not a financial services merger, use Siemens Alstom as an example because it's the most striking one. At the end, the prohibition was not about the high-speed trains. The prohibition was because the parties failed to come up with a remedy concerning the famous, train traffic light systems, where the two together would have ended up with a total monopoly. We told them, please offer a remedy on this, and you'll get your high-speed train. They decided not to do so. Maybe to now give a better example from the financial services sector. Indeed, if you remember the LSE Refinitiv merger last year, we cleared in phase 2, but with remedies because the parties offered to divest Borsa Italiana in light of the significant horizontal overlap that we had identified on the European government bonds market. So I think that to believe that competition policy is just an instrument to sort of make sure that there's many small, little, insignificant ones, I think misses the point, honestly.
Okay, we'll come on to banking union in much more detail in a moment. But just finally on monopolies or market institutions with undue market size. Is there a tension, do you think, between, for example, the formation of a large bank in a single member state with creating something with critical mass for the single market? So I think back to the discussion about the merger of Deutsche Bank and Commerzbank that came up a couple of years ago. Some argue that we create a undue market size for that institution in Germany. There are plenty who disagreed with that, actually. But it may have been useful overall for European competitiveness in the world. How do you balance those two factors?
Well, the first comment I would have to make is that, as you know, by virtue of the way in which the merger regulation is structured, we might have been unlucky and not even had jurisdiction in the case of a purely national merger. And as you may see, I mean, we've been waiting for years now, to see the European banking consolidation happen and finally have a few cross-border consolidations, which would have given us a little bit of fun and work to do. And so, when we read in the press the other day that who is it wanting to buy ABN AMRO? I forget now. One of the big French banks. Yeah, exactly. Sorry, BNP Paribas showing an interest in ABN AMRO. I mean, we were delighted. You know that by virtue of the thresholds of the merger regulation, if something is largely national, it wouldn't even have been for us. It might have been for the Bundeskartellamt. So, but that's detail. On the principle, we are instinctively hesitant concerning the creation of national champions. Why is that so? I think because this can create a risk to the market structure in the member state concerned, and be it the largest member state, by the way, of the European Union, without actually contributing to the overall objective, which is the important one, which is the integration of the European single market and creating actors who, because of their European scale, are able to compete further afield. And so I think that all the efforts that we are making, be they on the regulatory side or on the enforcement side, to further integrate the single market, I think should be seen in that perspective. So do I think that quote unquote national champions would really serve us so well? I'm not entirely sure. I
Okay,
think
that's
what we need is we need cross-border, and we need integrated European consolidated market.
Okay, and we'll come on to why that isn't yet happening in a moment. And indeed turn to you, Alex, to discuss banking union. But I wanted to go to the asset management industry first, Matthias. You're a market practitioner here on the panel. There are lots of famous regulations in asset management from the European Commission the last few years. From your point of view, tell us to what extent there is a cross-border single market in asset management services and what remains to be done to facilitate or improve it. And we've heard some of the actions talked about by Mr. Hartmann earlier on private capital.
Yeah, happy to do so. And in theory, we have a European asset management market. You know, we have a passport possibility, opportunity to have retail funds passported in any other EU member state without additional checks from the receiving country. And but we still observe that we have the national champions within Europe. 9 of the 10 biggest asset managers are based in the US. We only have 1 in Europe. Why is that the case? It is because whilst you have in theory the possibility to offer all your products in all of Europe, in practice we have gold plating, we have different tax regimes, additional national regulations, consumer protection laws which are not unified, which really hinders then to have a European-wide distribution, one market where you can sell one product to every country, and that means that the focus of most of the European asset managers is still on 1, potentially 2 countries, but not on 15, 20, 25. It is not one single market like the US market is. And then it is, and that ties in then with the banking landscape. Often the asset managers, they have one, where bank-owned, are bank-owned or associated with a certain bank. And since the banks are mostly national champions as well, the distribution is then also becoming more difficult to have various distribution partners, because often the banks are still the biggest distributors of asset management products. There you often then have a bank focusing on one provider or a handful of providers. And that means that we're lacking scale as a European asset managers, and scale is becoming more and more important in the asset management market. We see it on the passive side, where the fees are constantly going down, and you can only then earn money on these passive products if you have that scale, if you have really a mass production there. And so that is something to see how to get scale there. And yes, you can do mergers, but then you often have an overlapping product range, so that doesn't immediately solve the problem. But you really need to have one market where you can distribute your product.
To what extent do you think the fragmentation that you describe is a function of inertia, and to what extent in some markets is it protectionism hiding in plain sight?
I would say one, it has historical reasons, because some of the barriers have only been, I would not say completely taken away, but significantly reduced in the last 10, 15, 20 years. And but we also see that, for example, cross-border mergers of funds is very difficult, if not impossible, because of non-harmonized tax regimes.
Yeah.
So if you merge a fund, a German fund into a Luxembourg fund.
And which aren't the competence of the European Commission necessarily, or as we heard, need unanimity.
Absolutely, yep. But that means then that withholding taxes, other taxes might be due, which then could lead to the fact that the fund investor has to pay a significant amount of tax. And that means that part of his fund holdings will be sold. And so it's, if he doesn't have the money in cash on his account, then his fund holding or his investment in the fund will be sold by the bank immediately. So it's not impossible, but it is a very high barrier. Then we see the gold plating of EU regulations. You mentioned we have seen lots of EU regulations, some for the good, some are a bit more complex, some we will see evolving, particularly on the ESG side these days, where we see there a lot of countries have started things, the Commission has started things, but it's getting revised, it was not concrete enough, new aspects are coming in, and then member states are implementing these directives, but they often give them a national flavor. So they see our consumer protection law requires that we do this and this and this, which immediately brings you to a problem then if you want to distribute from a different country into that country your product, because then you have to see that your product design is in line with the national gold plating law. And if you have to do that if you just want to target 10 different markets, you have to have all that in mind, and probably you dilute your product there.
Yeah, so it's hugely inefficient. If you were able to change one thing, assuming existing competences of the Commission and the Parliament and so on, that improved the internal competitiveness of asset management in Europe and external. If there's one thing that does both, let me know. If it has to be two different things for each, let me know. What would they be?
It would be, and yeah, that's difficult. My wish would be that we have, if we have an EU regulation, that it has to be implemented as it is, right, without discretion to. I know that's not possible.
Okay. Yeah.
But
we'll just go over to do regulations instead of directives, and member states will scream because it, of course, reduces their national autonomy.
Exactly. Yeah. That would be the only way, but we know that probably not practical. But that would be the wish, because then you had a level playing field there.
Yeah. Okay.
And as I said, with the ESG regulation, even more important, because the one country is saying nuclear power is a good thing, the other country is banning it, and what do you do with your product then?
Well, that's an exceedingly complicated area that we'll come back to. Alex, whenever you start in any corner of the financial services discussion, you end up in all the others quite quickly, and we see the Capital Markets Union, Banking Union, to some extent monetary union, all intersect all the time. Banking union has stalled. There's no agreement on deposit insurance, and that it looks unlikely for the time being. Could you give us a whirlwind tour of where we are with banking union, accepting as we do that it's important, even if it's stalled?
Sure, thank you. Wonderful to be here. Thank you for the invite.
Great to have
so as a researcher based in Brussels, it's a bit frustrating to follow banking union, but one is always sort of split between the sort of strategic significance of it and the technical detail that gets stuck in the discussions between member states. So I think the progress is very tangible in maybe two of the three pillars. Of course, common supervision, I think that's genuinely universally seen as a success. Strong performance of not just the SSM, but also the harmonization of the national supervisors, much greater discipline, better disclosure. The resolution framework is now under review. I think there is a strong framework. There is MREL, the resolution funds having been raised by the largest banks, so that gives a much more resilient additional capital buffer, essentially, to make a resolution scheme work for the largest banks. Yet the SRB has, in effect, really only had one case, Banco Popular in 2017, And it hasn't really had that test of the market. The FDIC and the US, for instance, would have a steady stream at the best of times, and in the peak of the financial crisis had something like 160 banks they resolved every year. And of course, they manage the integrated US deposit insurance. So it's clear that needed to come under review, which is now ongoing. There needs to be this revision of the public interest, which banks should really be designated for a resolution scheme. And there needs to be a clearer interpretation of what the scope of national bank liquidation can be, which has been used to some extent as a national bailout tool. Maybe the glass is more than half full on those two pillars.
So we've got a safer banking system, but not necessarily competitive, I would argue. But
yeah. So competitiveness in financial markets, it's a tricky concept to flesh out. But I would say in terms of the contestability, so the market discipline on individual institutions, that's stronger through the regulatory and supervisory framework. It's weaker given that we split out the UK. There's less passporting from that market, less competition from that market, obviously. The UK, they made competitiveness an explicit mandate for the Bank of England. So you see that in two aspects: the application of exemptions for smaller banks, but also that any rulemaking now needs to reflect the standing of the UK banking and capital market in the international context. Yeah? So that's very different to what we practice here. No, I think we haven't seen that consolidation, right? So the fragmentation in the industry is still there, though it's not necessarily greater than, say, in the US, which has many small banks. But the fragmentation along national lines, I think that's the key impediment to competitiveness. And puts the euro area in particular still in a somewhat vulnerable situation.
Just to briefly to explore the reasons why banking union, or particularly deposit insurance, is stuck. That, simplistically speaking, seems to be a ongoing argument between Germany and Italy. Can you tell us what's getting in the way of that discussion, and can you see it being resolved anytime soon?
Well, so there are lots of, technical proposals how the national deposit insurance systems could be merged into a sort of common system of reinsurance. The key point is ultimately that you will not have a national liability for national bank failures. In the US, there is an unlimited backup, essentially, for the state system. We've had the backup to the SRB resolution fund through a common ESM backstop. That was the last innovation in creating a mutual support scheme for national bank failures. Right now, I don't really see, given the macro context, I don't really see that opening for, further burden sharing in the banking sector. Yeah.
Okay. Well, maybe we'll put banking union to one side for now. I know that I spent a lot of time talking to Jean-Pierre Moustier about this. Used to run SG and then UniCredit, and he was tearing his hair out. It was very short hair, but tearing it out nonetheless, that he had to separately capitalize in whatever it was, 20 different jurisdictions. And because he has to do that, he's at a disadvantage to Bank of America, say. We don't see that changing.
So if I may, there are still, what are called these options and discretions that national regulators have by law, which came out of the financial crisis, basically ring fencing capital and liquidity. Some of them, in the SSM practice, this has been largely weeded out, but there's still national rules that haven't been cleared up. So there is both the industry inertia and the lack of mergers, but there's also a regulatory side to this.
Okay, thank you. We'll come back to Capital Markets Union in a minute. Bart, we've had a question in from the audience that we were keen to move on to as well. Can you develop how the Commission services work together? This is a good question. Regulation and competition policy on vertical silos in trading infrastructure and the cost of market data. So I know that you're working on that.
Well, that's not an easy one, so I'm not sure that I'll actually answer the right thing. Yeah, if I don't, then please stop me immediately and tell me that I got it wrong and that I was supposed to talk about something different entirely. Several aspects to this. Yeah. In our work with DG FISMA, think about the upcoming PSD2 review. You know that there, one of the big topics has been, as from PSD2, you know, access to data held by banks to enable market entry by fintechs. Yeah, one topic. How are we working together with them? I mean, the review is in preparation. We're of course involved very clearly. And we're trying to, you know, draw the lessons, also draw the lessons from the criticism, if you want, or the concerns that we've heard from the banking sector, that, you know, they felt they were supposed to give access to quote-unquote their data, whereas the same was not necessarily true for other players on the market. Now, I mentioned concerning now the big techs, yeah, which have meanwhile happily entered the payments market, but also other areas of financial services, they will be under certain obligations by virtue of the DMA. Because the principle, yeah, same activity, same risks, same rules, is the one to which everybody in the Commission subscribes, be it Comp or FISMA or anyone else. So that's one data area that we're working on. Another data area that we're working on, this is more on the DG Connect side, is of course the Data Governance Act, which has just been developed, and now the Data Act, which is in negotiation. The idea there is to create European data spaces and to make sure that you know, the data can be used and reused in a way that allows, you know, the generation of efficiencies and, you know, and innovations on the basis of access and sharing of data, which then, of course, raises the interesting competition question. And how do you do that in a way that's not anti-competitive, that's not collusion, yeah, that's not a happy data cartel? Now, we are, in our regulatory advocacy vis-à-vis these other services, what we are trying to make sure is that the basic principles, so, you know, if there is access, it has to be frank, so it has to be fair, reasonable, non-discriminatory. What data are we talking about? Is it, you know, the gatekeeper siphoning off the data of competitors? That's a no-go. Is it people sharing data? Then how can you make sure that they do this without being a cartel? So that's the kind of questions that we are looking into. Now, I don't know whether that answered the question.
Just on the broader point of how you cooperate with other areas of the Commission working on overlapping areas, how does that work?
Well, I would argue that we've improved, frankly. I mean, everybody knows the old mantra of the Commission silos where no one talks to no one. I think these days are over. Yeah? Okay. And I mean, the DMA was a co-production between DG Connect, who was officially in the lead, and DG Comp. Because, as I said, yeah, most of the conducts that are now part of the DMA actually came from our practice. PSD2 will, and Open Finance, also the Instant Payments Initiative that's in the making over in FISMA. Yes, FISMA is in the lead. Yes, we are, of course, part of the inter-service group together with other interested services. So I would argue that, yes, of course, there's still, you know, it's still a bit sort of vertical, let's say. But I would argue that in the last couple of years, you know, the the cross-service work and also the sort of cross-fertilization of actually bringing different experiences together and sharing them in the Commission has significantly improved.
In terms of the principle of strategic autonomy, which is quite interesting, how does that sit in the context of things like the slow progress of banking union? So presumably a consolidated banking sector in Europe would improve its strategic autonomy, but banking union is stuck. How do you regard that tension?
Well, I mean, first of all, I would agree with you that a more integrated, more consolidated, more cross-border operating European banking sector would certainly go a long way in improving the resilience. I'm not so much into strategic autonomy, maybe because I'm from Comp, but yes, would definitely go quite some way in improving our resilience. Why is that so? I mean, let's face it. Just as during the COVID crisis, and now, you know, in light of the Ukraine of the Russian aggression in Ukraine, quite a number of the support measures that we've designed, which are for the real economy, were channeled through the banking sector, through financial intermediaries. Therefore, have also, you know, protected a certain, made a certain stability, let's say, to the financial sector. But coming out of this, going into recovery, the role of the financial sector will be even more essential to channel, you know, all the funding for the digital transition and for the green transition. So I would think, and there I would maybe, if I may, add a few thoughts to what Alexander said.
Please do.
The sad bits, and yes, I am allowed to say that we are disappointed about the fact that you know, the Eurogroup last week did not manage to agree on the full roadmap, but just on the review of the crisis management and deposit insurance framework. Why are we sad about this? Because it's all linked. It's, you know, some member states agreeing to, let's say, more of a European, let's be prudent, reinsurance system of the national deposit guarantee funds logically implies that some member states should make efforts to reduce the link between, you know, the sovereign and the bonds of the sovereign and the amount of sovereign bond holdings by the national banks. So that was clear that this would have to have been part of the package.
It's a bad time to put BTPs back on the market, I think. But let's just to field an audience question from Uwe Konst, which I thought was interesting, not all of you to address, which is that if capital markets union seems too difficult for the 27, is it feasible that a smaller group of countries might move ahead? This is somewhat in line with the articulations of Macron, who talks about a Europe of circles. Do we think that CMU could be pushed ahead by the Carolingian core of Europe, for example? Start with you, Matthias.
That's more a political question. From an asset management perspective, if a number of countries would move ahead and create a more integrated financial capital market, that's of course helpful for an asset manager.
Yes.
Whether it's really feasible is a different question, but you know, every part where we can have a level playing field will help us to become stronger, to become more competitive with regards to US asset managers, but will also help to bring projects forward, particularly on the infrastructure side, where I think all agree that we cannot finance that by the states any longer. Yeah. So we need private capital, and you can only raise private capital across jurisdictions if you bring the laws and regulations more in line there. And so from an asset management perspective, that would be welcomed. Whether it's practically possible, it's a different question.
Okay, thanks. Alex, what do you think about this? It sounds like that would actually go in the opposite direction of a single market. If you were to have a core that moved ahead with integration, that works against a level playing field in a way. So what's your view on whether it's feasible?
So I think the Commission has done a great job in flagging the technical requirements for the common single market in capital. But obviously that only goes so far, and as many people have said, there need to be bottom-up initiatives that are emulated by maybe a smaller group of countries. You see that, say, in the Baltics, there's more or less an integrated market in venture capital and equity. You had the common declaration by Spain and the Netherlands on the need for capital markets union. So you may find countries subscribing to a joint standard that gets a bit of a group of countries moving, and that will facilitate the work of the industry. You have very long gestation periods of EU legislation, and maybe we don't have the time to harmonize it fully. If you look at, an important initiative, I think, is the data access. The Commission has the single data point initiative. If that were to be emulated just by a group of countries that adopt the common template, I think that would be hugely valuable for IPOs and prospectus design. Yeah.
Okay. But you think it's conceivable you might have a variable speed Europe in terms of capital markets union, or you're saying we already have that?
Well, inevitably, because the market structures, the depth of pension systems in Sweden and in the Netherlands puts these countries in a very different context. Frankly, I don't see much progress on a funded pillar system being a major impetus to capital markets, though Poland, interestingly, is now reversing the reversal, as it were, so they're going back to that more liberal notion of a funded pension system. And, previously, 7-8 years ago, they styled themselves as a regional hub, so you may find, countries in Central Europe subscribing and using the Warsaw market as a base. So I think you will see more of that, if only because it's clear the funding needs, the need for sort of growth capital beyond the venture capital stages. So clear. Yeah.
The one topic that always comes up with Capital Markets Union is whether an agreement can be reached on bankruptcy standards, and I heard that last night as well over dinner with a senior banker. Do you think that can and will be resolved?
I think we've seen some progress already. I think the first of the two sort of bankruptcy insolvency initiatives, the restructuring directive, already had some good impact with the changes in Spain and the Netherlands, the new German insolvency law giving greater scope for sort of pre-insolvency restructuring. That's really valuable, and that shows a recognition that there's and the other impetus to that is the UK is no longer sort of the single venue for the resolution of insolvency cases. Yeah, so France tries to style itself as a sort of a new venue for that, and there's a recognition there needs to be more harmonization. So I think the second directive may go into an open door with member states. Yeah.
Okay, thanks. So just quickly to you on that, Barbara. I know it's not your competence, but do you think that will be fixed? I know it's slightly boring, but it does come up every time and seems important.
That what is going to be fixed? Insolvency?
Yes.
Look, one of the rather interestingly clear mandates that came out of the Eurogroup last week, as part of the CMDI reform, was actually that they did instruct the Commission to make a proposal on further harmonization of insolvency law, which I found remarkable, also because, everybody needs to be aware of how attached, let's say, national sovereigns have been in the past to, keeping this area to themselves. So I start from the assumption in a way that the forthcoming proposals may have to touch on that as well. Because it will not just be by harmonizing the public interest test or by harmonizing a bit more what the national deposit guarantee schemes will be allowed to do. I do think that it's essential at least to try and as much as possible further harmonize these conditions. Because from what I'm given to understand in discussing with stakeholders, including member state authorities, is that even though it's disappointing that this is the only thing that is supposed to happen between now and the end of the mandate, it would still, bring some benefits which might then allow for making more progress on the other pillars of the banking union going forward.
Okay, we're going to move on from banking union, capital markets union. I, which wouldn't surprise my children, have managed to come out of the question screen on my iPad here. But have any of you got any questions you'd like to ask the panel on capital markets union or banking union? Please raise your hand. I'd be very happy to put a question. Any questions for the panel? Yes, you, sir. Perhaps you could bring the gentleman a microphone.
Thanks, Pedro from AFME. Actually, just to follow up with Barbara, that very candidly acknowledge that maybe she was not responding to the question that was raised before on infrastructures and data. Indeed, you mentioned payments and you mentioned data governance, all very important issues, but on maybe on the less sexy plumbing of the European capital markets, the clearing and the settlement and the trading and the market data costs. Do you have a view on those markets, particularly on equities? You mentioned at your very beginning, you mentioned interoperability on Digital Market Act and also data availability. Mm-hmm. The European equity markets still work as silos, so if you trade in an exchange, you cannot clear on any other clearing. Just on the, is that something that's concerning for DG Com?
We are monitoring. I think more than that I cannot say.
I think
we
that's a yes.
are monitoring.
Yes and no, I think, is your answer. So, all right. Oh, thank you. So let's move on to a slightly more cheerful terrain. So Europe is setting standards in the world in ESG. It's an incredibly complicated area. There are internal conflicts that Matthias has already talked about. Nevertheless, I hear when we chair sessions, as I mentioned over dinner, when we chair sessions in the US, they are looking, market participants are looking to Europe to understand what to do next on ESG and financial services. So I'd like to hear from the panel how we think that that could actually consolidate Europe's position as a world leader and from a competitive point of view. So back to you, Matthias, on that. I know it's very, very difficult for asset managers to get a common set of standards. That's also a headache, but Europe nevertheless seems to be leading the way.
It is a headache, but ESG is a topic which is on the top agenda of everything at the moment. Not only the financial industry, it is a common theme, a common topic, and but the focus is mostly on the E, the environmental part, not the social and the governance, which are equally important. But if you look at the papers, if you look at the news, it's mostly the E. And the discussions I just mentioned, what is nuclear power, is it ESG friendly or not? It's again focusing on the E. The S and the G is as I said, as important, and maybe in other parts of the world, the S and the G is more advanced sometimes, I have to say. Mm-hmm. But still, I think the Americans are looking at the Europeans about the ESG, and a lot of people are saying, "Oh, you're so advanced, and what's coming next to us?" And there, we see different developments in the US. If you see the state of Texas, if you are banning some of the oil companies and other companies out of your portfolios, then you're getting on the blacklist in Texas, and the state pensions will not invest into your products any longer. So there we see where we always thought that is a very unified market that made the Americans strong, that we have completely different regimes by the single states, from California being very proactive on ESG and states like Texas being not so proactive. So, but I'm pretty sure and fully convinced that ESG is, you cannot turn back the clock any longer, and it's the right thing, and that we might have a competitive advantage for some time there, but the Americans, they're looking into that closer and more deeply now, and the SEC starts to set out rules for that. I think they will come with a good speed to follow up, and let's see that we are continuing to push here the topic, but that's also then for the EU to really have clear rules and which we can follow and implement, so that we don't have every other year a different regulation which contravenes probably some of the previous regulation, and sometimes it looks a bit like the whole EU regulation on ESG is a bit driven by NGOs, and I'm just saying it looks sometimes. Are
you suggesting that there's over-regulation already?
To some extent, yes, because for me it was not designed perfectly from the bottom, and now you're trying to adjust here and adjust there, which makes it so complicated. If one had to read all the papers, all the details about ESG regulations which are in place, it's almost impossible.
Barbara.
May I disagree?
Yeah, please do. I'm interested for you to talk more broadly about how you regard the ESG theme with respect to competitiveness, both internally and externally, given that we've just heard also earlier this morning there's a very wide range of new regulations about disclosure, and there's a very complicated discussion about the taxonomy against which the EU can't issue yet, the NGEU. Nevertheless, Europe is a world leader in this area. How do you regard all of this, Barbara?
Let me make 3 comments maybe. First, yes, it is true that, by introducing rules on ESG financial reporting before even having, got the rules on ESG company reporting in place, but which again now there is agreement on, so that's another success of the French presidency, of course created a bit of a difficulty for the financial sector, because in a way the financial sector will start to have to report on environmental and social and governance matters even before getting the data from potentially the companies that they have invested in. True, that creates a complication, but 2, I would argue that if you want to create products, where your retail investors, if you actually want to tap into retail investors, who may be interested in specific products precisely because they're green, then the only way to do that is by creating, rules which are sufficiently strict and which are sufficiently transparent. That doesn't mean that each and every product has to be green. But I would make a big distinction here. I mean, we all know that BlackRock, for example, now has one part of its portfolio which is supposedly entirely green. Does that mean that they will not also fund brown? Of course they will. Of course they will. So I think that not every product needs to be geared at the same type of investor. And I also think that if the EU in particular wants to advance its Green Deal agenda, which we do want, we will need to create, quote-unquote green products and green finance to finance also these types of initiatives. Now that, yes, there is still controversy on the taxonomy is very clear. Let's see how it will be resolved. There is one point that I would like to add from a competition perspective. And that is, as you know, sustainability. I mean, it's the same debate, we just call it sustainability in our little competition world, has been a very important topic in competition circles. Why? Because the question has arisen, how do you deal with so-called sustainability agreements? In other words, companies coming together, whatever industry associations coming together to design standards. How do you see that from a competition perspective? Is it a cartel and therefore you have to prohibit it? Or is this something that can be justified? And the reason why I want to make this point is because we have seen some industry initiatives emerging, you know, in banking sector, but also in the insurance sector. And we think that this is an area where you know, guidance, competition guidance can actually be provided. As you may be aware, DG Competition is in the process of finalizing both the review of the horizontal guidelines and of the vertical guidelines and the related block exemption regulations, and as part especially of the horizontals, you should find in the future more guidance on how to go about cooperation, industry cooperation, yeah, to achieve sustainability objectives.
Okay, thanks, Barbara. We're out of time. I want to give the last word to you, Alex, on this topic. We didn't get to talk about crypto regulation, but that's a moving feast anyway, and we'll do it next time. But Alex, a more or less binary answer from you. Do you think that in ESG we are going to have a complicated over-regulation, or is Europe going to be a global standard setter and competitive as a result?
More the latter. I think they should be proud of the sort of holistic regulation and transparency they've developed for the market. They've maybe belatedly begun to coordinate with other regulators. The central bank coordination is very strong already. We need taxonomies that are interoperable, so you can issue to the worldwide green bond and green product investor base, no matter what the location of the issuer is. Disclosure, I think they have been in the forefront. There is a concern about green tape, so the over-regulation and the taxonomy being overly complicated, but I think that is being addressed now. Yeah. Okay,
thank you very much to my panel. That was a whirlwind tour around lots of very difficult issues, so thank you very much indeed. We're moving now back to a market practitioner, so Adam Farkas and Andrea Ocel, looking very much forward to hearing how this feels for banks. Thank you very much, everyone.
Thank you.